All right, everyone. Thank you so much for coming. Welcome to Next Level Trade. My name is David Thacker. I'm the Director of Strategic Engagement for Kansas Global Trade Services, and we are thrilled to be bringing you this show, event, whatever you want to call it today. I have 3 housekeeping items, then we'll just jump right into it. First, the webinar is being recorded, so you will be sent a copy of the recording. You can feel free to rewatch, share it with friends as much as you would like. As you wish. So second, we have a tight schedule. We're trying to cap this at 30 minutes and value of everyone's time to keep it really fast-paced, high energy. So here's how we're going to do the Q&A in the chat. They are open. We actually have a dedicated staff member. You see her on as Kansas Global with the dark screen. She's going to be monitoring the chat and the Q&A for the entire webinar. We're going to collect all of those, and then we'll send you all a personalized response, answer, information to your question rather than answering it on air. This will save us time, make sure that we get you good information. If there need to be links, follow-up, etc., articles, we can make sure that we're really responding fully. So fill up the chat, fill up the Q&A with any comments, questions, things you'd like to know more, and you'll get something in the next week individually by email. Lastly, this is the pilot event of a pilot series, so your feedback, your comments, suggestions, critiques, compliments, snarks, and queries will all help us to make the future events better than this one or maintain the quality. So if you have some comments, some ideas, send it to us. If you thought it was useful and enjoyable, plan to join us next week, next Thursday, same time, and share this with people who you think would enjoy it. Without further ado then, our subject today is foreign exchange. And joining me are Dr. John Min and Andrew Wolfline from Tempus FX. They live and breathe foreign exchange every day. John is the chief economist. Andrew is the chief strategy officer. You can see their bios on the webpage or in the invite, I believe. So we won't spend time with that. Thanks for joining us, guys. I'm super pumped.
Awesome. Thanks for the invite.
Yeah, I'm glad to be here.
Yeah. So let's jump right into it and start with foreign exchange. So lay as a foundation. What is foreign exchange? Why does it happen? When does it happen? What goes on there?
John, go ahead.
Sure. Foreign exchange is a very simple concept. It's value of one currency relative to another currency. That's why it always comes in pair. And of course, you don't have to worry about foreign exchange if you don't believe in international business, sourcing goods from overseas or exporting. If you're just domestically focused, you can just zone out for the next 27 minutes. But if you're involved in any aspect of international business, if you're buying parts or if you're exporting or if you got offices overseas and you're collecting revenue, whatever, at one point, money has to convert from one currency to another currency. Now, what's amazing thing is foreign exchange market where the money is bought and sold on a daily basis, it is about $6 trillion a day. It's a massive. It's about 4 days of foreign exchange market is equivalent to the entire GDP of the United States. And out of that $6 trillion worth of money that's bought and sold, 97% of it is what we call hot trade or hot money. These are the speculators, hedge funds, pension funds, traders just moving money back and forth and back and forth. And as a result, you see tremendous amount of volatility, and that causes a lot of headache for a lot of people who are doing business internationally.
And the only thing I would add on top of that is that these values of these two currencies are constantly changing one against the other by the second. So the rate, you go and buy a piece of furniture in a store, that price is going to be there by the time you get to the register. But with currency, every few seconds, it's changing. So it's the barometer, the temperature of the economies and the one value of one currency versus the other.
And as Andrew was saying, sorry about that, but just to let you know, I know it's changing constantly, but the level of volatility is so amplified right now because every central bank I know is just creating money. So there's so much money they're slushing around. During the course of a month, we see exchange fluctuations up to like 2 to 3%. And during the course of like a month or even 60 days, 90 days, we could see movements of 10% just going back and forth, back and forth.
Now, for an individual company involved in import and export, they may be looking at the markets, but they're also looking at a very transactional level, right? So in a given transaction, let's say I'm selling, coffee mugs into Germany. who are the players? What happens if I want to sell this mug into Germany and for the exchange to happen between dollars and euros?
Well, what happened is if you're going to sell the mugs into Germany, if you sell in dollars and you just quote dollars, that's one scenario where you just give the German buyer an invoice in dollars, and they have to then manage the foreign exchange and go and sell euros and buy dollars to pay you. You can make it more convenient for your German buyer by giving them an invoice that's quoted in euro, so it's easier for them to buy it. So then in that case, you're taking on the foreign currency risk because you'll receive euros, but ultimately you want to convert it. You want to convert it back to dollars.
So if I'm charging only in dollars, then the risk is outside of my control. It's happening somewhere else. What happens there? What happens with the exchange rate? What happens with the unknowns that could negatively affect me?
By the way, this is what's known as a cost of convenience, because I do know there are a lot of companies in the United States, especially small to mid-sized businesses. They may not necessarily have a foreign bank account to accept the euro in the first place. And opening up a foreign bank account is just painful. So you have to go there in person. There's high maintenance fee and the tax implications. So you know what? I'm just going to make everything dollars. So I'm selling goods in Germany, let's say airplane parts. But then you're going to invoice them in dollars. I don't want the headache of foreign exchange. The problem with that is if I'm the buyer overseas, whatever the payment terms you extended to me, whether it's 30 days, 60 days, 90 days, the value of the dollar payment I have to make to you, it varies against the euro by the level of like up to like 10% in like 60 days. So you know what they do when they are selling, when they're buying from you, they're going to be negotiating your price. They're going to say, you know what? It's not worth the headache. I'm going to find a domestic supplier. And we see that a lot.
So charging only in dollars or not only it caused you to lose control of what risk happens with the actual exchange, because in that time period, in that 30, 60 days, let's say you're working with a company larger than yourself and they are active in exchanging currencies, that invoicing could cause problems for you depending or be negative or positive for them because of the exchange rate fluctuation, right?
Yep.
But it also creates more hassle for the buyer, which causes a company to lose their competitive edge.
Right. And on top of that, if you're selling aviation parts into Germany and you're only quoting in dollars, there can be competitors from other markets that are selling into Germany that do quote in euros. So you're at a competitive disadvantage against competitors. And if you have U.S. competitors that are selling into Germany who are only quoting in dollars, you can differentiate from them by quoting in the foreign currency. So you want to protect against other foreign companies that are quoting to match what they're doing, and you can get an advantage on other U.S. exporters who are not doing it, just by making yourself more convenient to the German buyer.
So a lot of companies I talk with, and even I had this perception for a while, was foreign exchange as kind of a play toy or an expensive tool for giant corporations. But what you're telling me, what we talked about here, is it's actually a very strategic advantage for even small and mid-sized companies to get involved in, not just to save pennies on billions of dollars of transactions, but as a competitive strategy against your U.S. competitors, against your foreign competitors, against competitors in the domestic market to which you're exporting. It can make a huge difference to long-term relationships and being able to get clients, right?
Yeah, no, that's right. And the other thing too, it's super easy to set up the mechanism to receive in those euros, to receive in British pounds, to receive in Japanese yen. We do this through a holding account, so clients can use us to receive those foreign funds. They don't have to go through the hassles that John was talking about, running around Europe and Asia trying to set up bank accounts so you can receive foreign currency. That's costly and it's time consuming. It's not efficient, but you can do that all here in the U.S. Receive all those foreign currencies through folks like us.
So David, this is what I tell a lot of our clients is that if you are invoicing in US dollars and if you're an exporter, just imagine what's it like as a buyer. You go to Amazon and you find a product that you like, but then you realize you have to make a payment in Canadian dollars or Canadian credit card. Guess what you're going to do? You're going to look for something comparable that you can pay in US dollars.
Yeah.
So there's a tremendous Okay. Well, there's
I've gone up to Amazon and it's been in Canadian dollars, and I was like, nope, I'm out of here.
Exactly. And of course, exporters just don't know those missed opportunities because they insist they want to do in dollars because it's just so much more convenient. But that's the cost of the convenience.
Yeah, and so that gets us into some of the reasons why companies wouldn't get involved, and that convenience is this perception that it's going to be super difficult, really hard, complicated. If you're not a giant company with dedicated staff to this, you've got so much on your plate. You're running multiple segments, and you're already overloaded as it is. That's certainly a big reason why I think companies would kind of back off or not, pursue trying to control this risk or trying to make it a part of their strategy, a competitive edge. What are the other reasons that you hear for companies of why they would be hesitant to get involved or kind of move forward on some of these things?
Well, there's export side to it, but there's also import side. And a lot of companies in U.S., they're sourcing parts and materials, intermediate goods from overseas. And they can also take the convenience route, which is just invoice us in dollars and we'll pay you in dollars. I don't have to worry about the foreign exchange. But reality is when you're getting invoice from overseas in dollars, that invoice price is padded up to 5 to 10% based on the term you extend, because now you just transfer the foreign exchange risk to your, sell overseas, right? So they will mark it up. And we have seen that consistently with our companies we work with by just doing the analysis. They're actually overpaying for those parts by 5 to 15%.
Right. And one thing they can do there in that instance is they can ask the overseas seller to give them an invoice in dollars and in foreign currency.
Exactly.
And we can just compare, and they can see when they're ready to pay the invoice, which is cheaper, to buy euros and pay the euros or actually pay dollars. And in 9 out of 10 cases, it's cheaper to buy the euros because they haven't been marked up like the dollars have.
And David, going back to your original question, which is why companies, especially in the U.S., they don't embrace foreign exchange way of doing business. They want the dollars. I would understand that position maybe 10, 20 years ago, because it's hard to pick up the phone, call the FX desk, talk to the FX specialist within a bank, and you got to get to the person. It's just cumbersome. But nowadays, fintechs and companies like us, we created a platform where a person can just go online and do every transaction seamlessly. It's almost like Amazon transactions, and it doesn't matter which currencies. I think we can support up to 100, Andrew, is 134 now?
We do 130.
Yeah. So what we're building in this case is that, it's a strategic disadvantage, but also depending on importing and how they're billing, and maybe even for the export side, they're losing money or making it more expensive for buyers because the rates are immediately inflated. Do you have like a number or an average of what those, you said 5 to 10%, is that an average of what those looks like in terms of how much they're inflated versus how much a company could save on invoices and supply chain?
Yeah, based on a survey we did a couple of years ago, just doing the dual currency, trying to see what the markup is. It is a function of the payment term that you extend to your transaction. So longer the payment terms, more padding because there's more risk of volatility. So if it's net 30, usually it's about 3 to 4% premium that you're paying to do business in dollars. And if it's net 90, some of these parts like machine tools and things like that, they go with a net 90 plus. Those are like 12 to 15%. We've seen as high as 20%. But again, it's based on the level of volatility in the market. And right now, the volatility is really amplified. So we expect more premium to be added. So dollar is very expensive currency to use. It's convenient. I'm the first one to say.
Right.
But it's very expensive.
But it's expensive.
The other thing I would add too, David, is that a lot of American companies, we see that, someone working in accounts payable or accounts receivable, 80, 90, 95% of what they're doing is just the domestic business. So the foreign currency piece is a headache. They're not as familiar with it. It's a hassle. They just want to get it off their desk. They don't know what quite to do. So the easy thing is to default to dollars in many cases. But that lack of knowledge can really cost them, as we're talking about, 5-10% on these transactions, which is a big piece of profit margin on a transaction. So it really pays to be educated about FX and take advantage of what's available in the market to manage that.
Yeah, and this is where you guys have come in. We talked a little bit about this, but you mentioned how in the past and even some traditional methods are really cumbersome and really are only available if you're doing lots of business in a particular market. If you are able to have a permanent address or a new bank account, what are some of the tactics a company can take? Maybe offer what you guys do that make it easier. What would that ultimately look like for a company to start taking control of this risk and being able to ultimately be more competitive, be more strategic, and save 3 to 10% on different invoices or do better business without being too inconvenient? What would that look like?
Yeah. Well, I'll take a first crack at that, and then John can build on it. But one of the things we think is important is you first establish a relationship with a specialist. You discuss your needs, you discuss your payment flows, what's happening, your inbound, your outbound, to get an understanding of the big picture, right? To understand the types of flows you have. And then you craft a solution using different types of tools. So, for example, you can buy and sell currency out into the future, 3, 6, 9, 12 months. So you can lock in rates today for a transaction that will take place in the future. That can protect your margin. We talked earlier about holding balances. We hold foreign currency accounts for clients in 34 currencies, and having that ability to not have to go and open up accounts in Germany and Asia or wherever, it really is very convenient. We have tools where clients can say, if this currency got to this rate, I will buy it or I will sell it. So they put in what are called market orders, and they can use that as part of a strategy. So there are a lot of tactics they can use, and it's important to have someone on their side, so to speak, who can help them work through the different options and put in place something that's specific to them and their flows, their currencies. And the volatility, it can vary by currency. So understanding which currencies they're operating in, that can inform a little bit the strategy that we might use to help them put a solution in place that's relevant for their specific needs.
And building on what Andrew was saying, that a lot of people don't know this, but there are about 7,000 banks in the United States. And other than about 24 top tier banks, no one does their own FX. I mean, they may offer services, but really they are taking your transaction request and handing it off to one of these big banks. We call it corresponding banks. So as a result, there's no one at your bank that you can talk about the foreign exchange, pricing, execution, even hedging strategy if you want to go there. So there's an expertise. Now, if you're dealing with big banks like JP Morgan, Bank of America, Deutsche, whatever it might be, they don't want to talk to you unless you're very, very big. So most of our clients who are dealing with the big banks, they don't even have a phone number they can call to talk to a foreign exchange expert, because they're not going to pick up your phone call unless you're doing trades of 5 to 20, 30 million at a time. So you're pretty much given an online platform, like a treasury platform, and you have to kind of figure things out on your own. And again, foreign exchange is foreign to a lot of companies. And I think that also creates like a barrier to entry into this world of doing business in foreign exchange.
Yeah. And one other thing there, the issue that a lot of the banks, these banks that are outsourcing it to others, the pricing then gets out of control because they're marking up, one bank is marking up another bank's rates. So the rates of exchange are really not competitive. So they eat into the profit margin of the companies.
So again,
and David, I should have mentioned this. This goes to your very first question, basics of foreign exchange. A lot of people don't know that all foreign exchange transactions, doesn't matter whether it's $100 up to 10 million, they are OTC transactions. These are the over-the-counter, which means they're all negotiated price. There's no standard price. So if you go to 3 different banks, they're going to give you 3 different pricing for exactly the same transaction at that moment. And as a result, as like Andrew says, is that some banks, they'll charge whatever they can because that's the price. And if you agree to it, That's a contractual price. So you got to be very careful as who you're working with.
So again, it seems like the core difficulty and what we're really honing in on is, one, the cost of doing foreign exchange, or the cost of not really controlling it, or working with the wrong people can really be prohibitive. And two, you want someone who knows foreign exchange and who knows your company, or who's willing to get to know your company, so that they can create the right strategy for the company. Because what works for a $400 million company isn't the same as what works for a $40 million company, right? And so you need, and what happens in one currency isn't necessarily the same strategy that works for another currency,
right?
Or someone who sells more one-off, because a couple of things you mentioned seem like long-term. So if you know you're going to be getting receivables in a certain currency on a regular basis, then some of those long-term of hedging, of having of accounts, right? If you know you're going to be buying and selling in euros because you're buying some parts, or you're buying certain things in for a German subsidiary, right? If you know those things are going to happen, then that's a certain route you would take. Whereas if you're a company that sells one here, one there, you may not want to do the same strategies because it's not necessary.
Yep.
Right. And the other thing too, if you've got different currencies, having it concentrated in one place is helpful because the service level is the same, the response time. If you've got one with an account in Germany and one in Japan and one in Mexico City, the levels of service can be very different, and different costs, different response times. Concentrating it with one provider who can do it all for you can really make your back office more efficient too.
So putting this together, when a company is self-examining, how would they choose or decide, right, that they should really start trying to control this, to take proactive steps? So back to my coffee mug example, if I'm making custom coffee mugs that are $20 and I'm selling all of them in the US, but I have one shipment to Germany, right? It wouldn't make a lot of sense for me to try to produce a whole strategy on that, because that's not a big part of my business. I'm not selling enough. What should a company look for within themselves, or what should someone look for in a company to say, yeah, we cross this threshold, we meet these certain requirements, that this would be a good investment of time and of thought for us to make?
Well, so one of the webinars I'm going to do after this one is geared towards exporters. And this year is going to be a fantastic year for exporters. So if you have any participants here and you're looking for a way to boost your revenue by 10%, all you have to do is focus on export, because we do expect the US dollar to continue to depreciate, simply because we're printing $80 billion worth of US dollars every single month. Money control is out of control, and inflation is already picking up now, so the dollar is already depreciating. Now, given that, if you are invoicing in euros on your exports, but if the dollar is depreciating by 10%, that's extra gross profit margin of 10% when you bring it back home. Great opportunity, but you miss out on that, because if you invoice them in dollars, then you're actually giving the buyer overseas 10% price discount, because they can afford to buy cheaper dollars and pay you. So you're going to miss out on this tremendous opportunity for next year or two. That's a consensus forecast. By the way, Goldman Sachs thinks the dollar is going to decline by 20%. Citi also thinks it's about 20%. We already lost 5%. So we got another 15% to go. Great opportunity if you're looking for growth this year.
So is there a threshold, a transaction threshold, or a yearly foreign sales threshold into a single or all currencies that you look for when you're advising a company of when to take these proactive steps?
Well, part of that is if they have an ongoing need. So if they have a transaction every month, that would be an example where they might want to start really thinking strongly about foreign currency and foreign currency strategies. The other thing, too, is the size of the transaction. So your example, $120 sale, no, they shouldn't do it. But, if we're at $500,000, $1 million and above, they should be thinking about about currency and how they can take advantage of the tools available to lower costs or improve profit margin. So, we see small and mid-sized companies dealing from a couple of $1 million a year to, 10, 20, 50, $100 million a year. So, anywhere, obviously, when you get 10, 20, 30 million, you're going to want to, of course, be, really engaged on your currency program. But smaller companies too can benefit from as well. I think if you're $500,000 or more, you should be thinking about it a little bit and trying to put in place these tools.
Another way to look at it is if you're involved in import and export, and if your gross profit margin is less than 20%, then you better pay attention to the foreign exchange market, because half of your profit margin is at risk within the period of 90 days. Or you can double your profit margin by doing business in foreign currency and riding the depreciation of US dollars.
Right. And once they get that threshold, that means they're doing regular business, which means now they're in really direct competition with foreign suppliers. They have people who, if they got a better price, if it was more convenient to do business in euros or whatever it may be, they would consider going and changing supplier potentially. And so it's protecting market share, maybe expanding market share regionally by being able to compete with local domestic producers in that market and have a step up on American producers that are only charging in dollars. Right?
Mm-hmm.
That's exactly right.
Perfect. So we have a couple minutes left. I know you guys provide a solution. You guys have talked about it a little. We've hinted at it, hopefully bridging the gap between some of the complexity, maybe some of the difficulty with working with a larger or less involved partner. Can you walk me through, just talk about what a next step would be if a company's on here listening, thinking, you know what, I think I fit. I think it'd be worth taking a look. What should they do?
Well, definitely we would be happy to contact them. They can contact us. We can do an individual walkthrough of the company, introduce what we do, show them our online tool, how that can be used to manage a lot of aspects of their foreign currency needs. One thing I would mention is, we have gone out of our way to develop an approach that takes into account, a company that uses these services. So, our system is not jargony, technical language. It's for users who are business people. It's very clean, intuitive. So, we'd be happy to share that with anyone in the audience who would like to drill into it a little bit more. But that would be, I think, the next steps to talk with us, get in touch with us. We can do a walkthrough of Tempus and show our platform and how that can work.
And one thing I like to clarify is that we are not credit issuing bank. So trying to work with us doesn't mean you need to open up another banking relationship, establish credit line with us, which can be painful. We are transaction by transaction basis. So
it just that it wouldn't interrupt their current relationship with the
bank. No, absolutely not.
We coexist. We complement
exactly. We complement it.
Yeah.
Perfect. All right. Well, that's all the time we've got for today. Thank you so much, John and Andrew, for joining us. Thanks for all of you who are sticking with us to the end here. After you close the webinar, a 4-question survey is going to pop up. If you took the time to answer that, it may not seem like much, but that would be super, super, super helpful for us to make sure that we keep providing value. Next week, I'm sitting down with our very own Karen Page, talking trade policy in the Biden administration. And the week after that, I'm talking with an export and supply chain financing expert, nationally renowned. So you won't want to miss either of these. So watch your email for follow-up information on Tempus, as well as registration information. And also think of any friends you might know that would need a 30-minute break on Thursday afternoons, and feel free to share it with them. Until next time, I'm David Thacker, and this is Next Level Trade.
Thank you. Yeah, bye-bye.